Hello and welcome to Money Talks for Life, the podcast that brings clarity to your financial world. Today's episode focuses on an essential and often misunderstood topic: how to access money from your 401k plan while you're still working, specifically through regular and hardship withdrawals. If you've ever wondered how to use your retirement savings for unexpected needs or emergencies, this is the episode for you. We'll cover what regular and hardship withdrawals are, who qualifies and under what conditions, what types of contributions you can access, how withdrawals are prioritized, and what taxes and penalties you might face. Let's dive in. Segment 1. Regular, ordinary withdrawals. Regular withdrawal, sometimes called an ordinary withdrawal, is one of the main ways to take money from your 401k while you're still employed. Here are the key things to know. Eligibility. Regular withdrawals are typically only available to participants who are actively employed. In other words, you don't need to quit or retire, but your employer must allow it. Plan discretion. The plan sponsor, usually your employer, decides whether to offer this option. They also determine which types of money you can access and in what order. This sequence is known as the withdrawal hierarchy. Money types available. While each plan may differ, regular withdrawals generally include access to the following types of contributions: after-tax contributions, rollover amounts from previous plans, and employer contributions like matching or profit sharing. However, and this is critical, you cannot access your before-tax contributions, Roth 401k contributions, or any earnings from those sources under a regular withdrawal. Order of withdrawal. When you request a regular withdrawal, the plan pulls money in a specific order. Typically, it starts with grandfathered after-tax contributions that have no earnings. Then it moves to non-grandfathered after-tax contributions and their earnings. After that, it draws from rollover amounts, and lastly, employer contributions and their earnings. Segment 2. Taxes on regular withdrawals. If you choose a regular withdrawal and take the money in cash rather than rolling it over, there are tax consequences. Federal tax. Withholding. The IRS requires the plan to withhold 20% of the withdrawn amount for federal income taxes, unless the money is directly rolled over to another qualified account. 10% early withdrawal penalty. If you are under age 59-12, you may owe an additional 10% early withdrawal penalty unless you qualify for a specific IRS exception. IRS Form 1099-SAR. You will receive this tax form in January of the year after the withdrawal. It details how much you withdrew, how much was taxable, and how much was withheld. The IRS also gets a copy, so it's essential to report it accurately on your tax return. State taxes. Depending on where you live, your withdrawal may also be subject to state income tax withholding. Regular withdrawals can be rolled over, which helps avoid immediate taxes and penalties. However, once taken as a cash distribution, you'll face taxation. Segment 3. Hardship withdrawals. What are they? Hardship withdrawals are a special provision in many 401k plans designed to help participants deal with immediate and severe financial needs. But make no mistake, they are tightly regulated. Here's what you need to know. Plan. Adoption is optional. Employers are not required to allow hardship withdrawals. According to 401khelpcenter.com, around 83% of plans do allow them, but only about 4% of participants take advantage of them. When they're allowed, a hardship withdrawal is only permitted if you have a genuine financial need and you have no other reasonably available resources to meet that need. How eligibility is determined. The plan administrator reviews your request and can use one of two methods: the IRS safe harbor rules or the facts and circumstances approach, or a combination of both. Segment 4. IRS safe harbor rules under. The safe harbor approach, a hardship withdrawal, is considered valid if it's for one of 6 approved reasons: medical expenses for you, your spouse, dependents, or beneficiaries. Costs related to buying your primary residence. Note this: excludes mortgage payments, tuition and educational expenses for the next 12 months, for you or your dependents, payments to avoid eviction or foreclosure on your primary residence, funeral expenses for yourself, your spouse, children, dependents, or beneficiaries, expenses to repair damage to your primary home that qualifies for a casualty deduction. Documentation is required. For example, medical bills or insurance explanations, a signed purchase agreement for the home, tuition invoices, or an eviction notice. Once the need is established, you must also show that the amount requested doesn't exceed the need. You've exhausted all non-hardship loans or distributions available from your employer's plans, and you've considered other financial resources like insurance, asset liquidation, or commercial loans. Segment 5, the 6-month suspension rule. If your plan follows the IRS Safe Harbor rules, there's another important requirement. You must stop making contributions for 6 months after receiving a hardship withdrawal. That includes Roth and before-tax contributions, and any company match will stop too. In the year following the hardship distribution, your contributions cannot exceed the IRS annual limit, minus whatever you already contributed before the suspension. For example, if the contribution limit is $23,000 and you contributed $6,000 before the hardship withdrawal, you can only contribute $17,000 after the suspension ends. Segment 6, the facts and circumstances approach. Now, if your plan uses the facts and circumstances method, it can allow for additional hardship reasons beyond the IRS safe harbors, things like basic transportation issues or catastrophic financial events that aren't listed under safe harbor. Rules. Under this method, the withdrawal process still includes documentation and a demonstration that no other funds are reasonably available. However, the 6-month suspension of contributions is optional, not mandatory. Segment 7, contribution, types and hierarchy for hardship withdrawals. One big difference between hardship and regular withdrawals is the type of contributions you can access. Under a hardship withdrawal, you can withdraw your before-tax contributions, your Roth 401k contributions, and other types like after-tax, rollover, and employer contributions, depending on the plan. However, there are important limits. You cannot withdraw earnings on before-tax contributions made after December 31st, 1988, and you cannot withdraw any earnings on Roth contributions unless you qualify under age 59, 1-2, or via final distribution after separation. The plan also determines a withdrawal hierarchy, usually starting with the most unrestricted sources like grandfathered after-tax contributions, then non-grandfathered after-tax plus earnings, followed by rollover money, employer contributions, and finally, your before-tax and Roth contributions. If the withdrawal amount can be satisfied from the first few categories, it may not need to tap your before-tax or Roth money. In that case, the system will treat it as a non-hardship withdrawal, avoiding the 6-month suspension altogether. Segment 8, taxes on hardship. Withdrawals. Hardship. Withdrawals are not eligible for rollover. They must be paid out directly to the participant. Here's how taxes work. Optional federal withholding. The IRS allows, but does not require, 10% federal tax withholding on the distribution. If you don't explicitly waive it, the plan will automatically withhold it. But remember, even if you waive the 10%, you still owe the taxes when you file your return. Early withdrawal penalty. If you're under age 59-1-2 and don't qualify for an exemption, you may also owe the 10% penalty tax on top of regular income taxes. State taxes. Many states also require withholding, so your net payout might be reduced even further. IRS Form 1099-R. Like all 401k withdrawals, you'll receive this form in January of the following year. It shows the taxable amount and the taxes withheld. Closing segment. Final thoughts. So what have we learned? Regular withdrawals offer limited access and are subject to standard tax rules. Hardship. Withdrawals provide a lifeline in emergencies, but come with strict eligibility and tax consequences. Always check with your plan administrator to see what your employer allows. Understand the withdrawal hierarchy so you know what money is being accessed. And most importantly, get professional tax or financial advice before making a decision that could impact your retirement security. That wraps up this episode of Money Talks for Life. If today's show helped clarify the complex world of 401k withdrawals, share it with a friend, a co-worker, or your HR team. You never know who might need this information right now. And don't forget to subscribe for more episodes, where we break down money topics that matter to you. Remember, this content is for educational purposes only. For the most up-to-date rules and changes, always check the official IRS or Department of Labor websites.